One of the main challenges facing the Federal Reserve is how to deal with the persistent rise in inflation. The Fed's preferred measure of inflation, the Core Personal Consumption Expenditures (PCE) price index, has been running above 4% for more than a year, well above the Fed's 2% target. This means that the prices of goods and services that consumers buy have been increasing faster than their incomes, eroding their purchasing power and living standards. The Fed has maintained that this inflation surge is largely transitory, driven by temporary factors such as supply chain disruptions, pent-up demand, and base effects from the pandemic. The Fed has also argued that its ultra-loose monetary policy, which includes keeping interest rates near zero and buying $120 billion worth of bonds per month, is necessary to support the economic recovery and achieve maximum employment. However, some economists and market participants have questioned the Fed's inflation outlook and policy stance. They have warned that the Fed may be underestimating the inflationary pressures in the economy and may be falling behind the curve in tightening monetary policy. They have pointed to signs of rising inflation expectations, wage pressures, and broadening price increases across various sectors and categories. They have also expressed concerns about the potential negative consequences of prolonged high inflation, such as reduced consumer confidence, lower real growth, and increased financial instability. The Fed will face a crucial test of its credibility and competence on Tuesday, when the latest PCE inflation report for November will be released. Analysts expect the core PCE price index to rise by 0.4% month-over-month and 4.7% year-over-year, matching the highest annual rate since. If the inflation report comes in higher than expected, it could put more pressure on the Fed to signal a faster pace of policy normalization at its upcoming meeting on December 15. On the other hand, if the inflation report comes in lower than expected, it could give the Fed more room to stick to its gradual approach and reassure markets that inflation will eventually moderate as the transitory factors fade. Either way, the inflation report will be a key indicator of how well the Fed is managing its dual mandate of price stability and maximum employment in a complex and uncertain economic environment.